Hey everyone, how's it going? That was the closing bell on Monday, November 27th. Super quiet. So, as I was saying in the pre-market, we may not have the full institutional participation today because there might be people who are traveling still. And it definitely looks like the case. Super quiet today. So let's take a look at how everything played out. If I look at this SPY on a daily basis, you can see that there's this tiny little bar. There's a tiny bar on Thursday. It's basically the same size as the bar on sorry, not Thursday, Friday, where it was only a half day. So we matched that, and it's smaller than the other two bars of that week. So Wednesday and Tuesday, today's range is really limited. However, it is the first sign of weakness that we've had in a really long time. If you look at this, there was a red bar right here, but that red bar is still up 0.21%. So it just opened higher than the previous day and closed a little bit lower, but is still a gain off of the previous day. This is the first down day we've had in almost 2 weeks. The really only down day that we had was this large red bar right here, and that was nothing. That was just a pullback to the MA50, and then we went higher. So this entire period right here, there's only been this one down day all the way until today is the second down day. Even though it's not significantly down, it's only 0.18%. That the fact that it's down a little bit and the tiny minuscule size of this bar together shows diminishing momentum. It is slowing down. This upward trajectory is petering out. We're hitting the apex, and that allows us to fall back down. So it's looking a little bit more like we're actually going to get that pullback. We're not necessarily going to get that sideways momentum. If we had normal size bars, like this size bar, or maybe even these size bars, throughout this period, then I might say it's consolidation. The fact that we're diminishing in range is a clue that we might actually pull back. So let's see that on the day chart. You can see that all we did today was we we basically matched the pre-market range during the normal session, which is pretty rare. But all we did was bounce between the previous close and the previous low. So, and look at the previous high. So we only have half the range actually as Friday. So this bar today is half of what it was. Oh, I'm sorry, not Friday, on Wednesday. So Friday was also extremely tiny, but it was only a half day. So we are only half the size of the Wednesday bar, and we only traded between that previous close and previous low. Now, again, the fact that it is at the lower half, if we had been bouncing between the previous close and the previous high, that might indicate a little bit of strength. But since we're bouncing back and forth between the previous close and the previous low, that is another indicator that there is weakness starting to creep into the market. That's really good news because, like I said, we need a pullback before we can move higher. So the sooner we get that pullback, the sooner we can start that seasonality move higher into the close of the year. But for now, we're just going to still anticipate that we're going to have that pullback maybe to the EMA 20, which would fill this gap right here, halfway fill this gap. If it's a deeper pullback, then we'll hit this sea green line right here, which was that MA90 breakout. And then we can resume upwards. That's the most likely scenario right now. This momentum is at its end. So we really should see it falling and not really consolidating to the side. Other than that, let's take a look at our sector rotations, see if we started to make that move that I was talking about out of the tech and into the more blue chip stocks. So if I go over here to my sector scan, I can check out what happened today. And what we see is that real estate caught a bid, so that this might have been a good report on new home sales. Nope, actually it was not a great report on new home sales, but given the lightness in range of the market today. And also you can see that the volume, it was also very low today still. So, the fact that it wasn't really following the direction of the report, we're not going to read too much into it. So real estate, gold, consumer discretionary still up, conductors still up. So we have a mixed bag. The technology and semiconductors aren't way at the top anymore, but we also aren't seeing a full rotation into the blue chip stocks quite yet. Although we do see gold going up, that is a flight to safety. And then we also see that utilities are creeping up over here. So it does very much, and then looks like the bonds went up. Let's take a look at that. Okay, so bonds bounced back up. So really what we're looking at now, rather than looking at it as this ascending triangle that we were looking at it before, we're going to start looking at this as it bounced off of the EMA 20, it bounced off of the EMA 8. So it does, in the short term, look like we are going to continue to move a little bit higher unless we break through those two levels. But for now, it is bouncing off of the EMA 8. So the expectation is that rates will continue to move higher. That is positive news for NASDAQ, but let's see what the NASDAQ did. Okay, flat. So same thing as the S&P, just baby, it's actually down. It's a green bar, but it's down 0.10%. So everything that I said about the S&P 500 applies to the NASDAQ as well. So we are losing momentum, we're curving, we're flattening, we're hitting that apex. It really does look like we're going to pull back, except we have more room to pull back, or this can fall harder than the overall S&P 500. Now think about what that means, because almost every single stock in the QQQ is also in the SPY. So almost all 100 of the QQQ are contained within the 500 of the SPY. What that means is if I see that there's a more potential for pullback, a sharper move in the QQQ, that means those sectors that the QQQ are heavy in, which are the consumer discretionary and the tech, have more room to fall. And the S&P 500 isn't going to fall as much because it has other sectors in place. So if those sectors don't fall as much, or some sectors continue to rise, then that would explain a difference in pullback depth in the Q. Topping out of the DIA as well. The difference is this is the first sideways movement that we've had this entire time, except for this consolidation right here. But after this move upwards, this has been a steady climb upwards. And again, these red bars are red, but I guess this one was down. This one's a down day. So today is also a down day. We are losing momentum here, but this is the first sideways day in the diamonds versus the 1, 2, 3, 4, 5, 6, 7, 8, 9th sideways day in the QQQ. And the maybe 1, 2, 3, maybe 4th sideways day in the S&P 500. So you can see this sector rotation playing out in slow motion within the markets, within the indices. But it'll be a little bit more clear if we check out, for example, oops, why did that work? So we can see in the 1 month over here, SMH and tech clearly leading, and the consumer discretionary as well. If I look at 2 weeks, clearly on the top. If I take a look at 1 week, you can see that they're still at the top. If I look at 1 week, you can see that they're way at the bottom right here. See that? So we are starting to experience that sector rotation. And then today, not quite as obvious on a 1 day level,
but we're going to expect that that change from the 2 week to the 1 week continues, and we see that separation of sectors. All right. I think that's about it in terms of today's market. I mean, super quiet, right? That small, tiny range, low volume. We're losing momentum. We really should start to see this more likely to start pulling back, and then a pullback perhaps as far as the EMA 20, if not more. And then we already looked at bonds. We looked at the economic calendar. So tomorrow we've got some more housing index. That's not going to be anything, actually, this FHFA thing. So really it's consumer confidence, which is half an hour after the open. So we'll be looking at that very carefully tomorrow morning. So everything right now is momentum is slowing down. It looks like we're now at this point, again, slightly to favoring in terms of probabilities, favoring a pullback, at least to the EMA 20. And this upward movement along that Keltner channel, that 3 ATR Keltner channel, it really does have to crack, and we should pull back at least a +1 ATR level, if not to the EMA 20. So any positions that we have that followed along these lines, if we are long those positions, I would definitely be taking profits on those before we get that pullback. And if we were short those positions because we're expecting that pullback, hang on for the ride. We're going to expect that it's going to come at least to that +1 ATR relatively soon, probably sometime this week, but probably maybe even the first half of this week rather than the second half of this week. All right. That's it for today. There, again, not that much happened in the markets, so there's not that much to talk about. I'll see you tomorrow morning, and we'll take a careful look at what is going on in terms of consumer confidence. All right.